Good afternoon, everyone. Thank you for joining us for today's webinar. Today, we're going to walk through the key elements of the new tax legislation, officially titled the One Big Beautiful Bill, which was signed into law recently on July 4th, 2025. This presentation will help you understand what are the changes being made, what's staying the same, and what it's going to mean for individuals, families, retirees, and businesses. So before we dive in, let's do introductions. I'm Tamim Qasim, a financial associate here at Azzad. I'm also joined by my colleague, Ihab El-Alafi, senior financial advisor here at Azzad. Assalamu alaikum, Ihab. Thank you for
Alaikum
joining.
salam. How are you, brother?
Good, alhamdulillah. So Ihab will be discussing how the new tax bill affects estate planning and wealth transfer. Ihab is a second generation financial advisor who has 2 decades of experience in the financial industry and is passionate about helping American Muslims across the US get their financial lives in order and aligned with their Islamic values. So there's a lot to go over today, so let's get started. Let's begin with a little context. The One Big Beautiful Bill is not just another update, it's a sweeping overhaul that touches nearly every aspect of your personal and family taxation, from income and retirement to estate planning and social programs. The changes are very broad and impactful, with many provisions already in effect and others phasing in or out over the next few years. Now is really the moment to understand what is going to change and how you should respond before your year-end planning begins. So now that the bill is law, let's look at what is actually in it. First, it makes the 2017 Tax Cuts and Jobs Act, the TCJA, permanent. So that means that the lower tax rates that were introduced then won't expire. It also expands on deductions for families and seniors, and it introduces new savings accounts for children and offers some temporary tax relief for workers. And then on the flip side, however, while it's also going to include some spending cuts. So while there's relief, there will also be some restraint with social programs. Not everything in the bill is permanent. Some provisions, like the lower tax brackets, will be permanent, are here to stay, but others, like the tip and overtime tax relief, are temporary and they will expire after 2028. It's important to know which benefits are long-term and which ones you'll need to plan around before they sunset. So let's dive into how the bill is going to affect individual taxpayers first. From income brackets to deductions, there's several updates that could impact your filing strategy and your refund potential at the end of the year. One of the biggest changes we're seeing is the permanent extension, as previously mentioned, of those lower income tax brackets that were introduced, originally set to expire in 2026. Alhamdulillah, now these rates will remain in place, preventing an automatic tax hike for millions of Americans. So this gives some taxpayers a lot more certainty when planning for their future. This larger deduction means more income is sheltered from taxes, so the standard deduction has been increased across the board. For joint filers, it's rising from 29,200 to 31,500, and then for single filers, we're going to see it go from about 14,600 to $15,750. And this change means more income is shielded from taxation, which could result in lower tax bills for many households. Now, seniors age 65 and older with limited income now qualify for an additional $6,000 deduction. To be eligible, their income must be below $75,000 for single filers and $150,000 for joint filers. This bonus deduction is designed to offer targeted relief to older Americans who may be living on fixed incomes. Another provision, the higher alternative minimum tax exemptions that were introduced under the TCJA are also now made permanent. So this means fewer upper middle income taxpayers will be subject to the alternative minimum tax, simplifying tax filing and reducing surprise liabilities, especially for those individuals who have incentive stock options, which could trigger AMT at the time of exercise. So now let's move into the section that matters most to the families. This is the part of the bill that introduces new benefits for parents, children, and newborns. Some are temporary and some are long-term. Whether you're planning for next year's refund or your child's future, there's a lot to unpack here. So here's a big win for families. The child tax credit is going up from $2,000 to $2,200 per child. That extra $200 might not seem like much, but for family with multiple kids, can add up to a nice little, small little bonus there. Just keep in mind that this increase is temporary. It's set to expire after 2028, and after that, it'll go back to the inflation adjusted 2000. Also, to qualify, your child must have a valid social security number, so please make sure that that's squared away. And then this is one of the more headline-grabbing additions in the OBBA. Starting this year, every newborn gets a $1,000 federal deposit into a new type of savings account with the bill, what the bill calls a Trump account. So parents can contribute up to $5,000 a year of after-tax money. What's unique, however, is how flexible these accounts are. So the funds can be used for a wide range of things, for education, job training, or a first home once the child turns 18, and then lifts all restrictions on what the money can be used for after the age of 30. So what does this mean for you and your family? Well, if you have qualifying children, you could see a bigger refund thanks to the increased child tax credit. If you've recently had a baby, those new Trump accounts could offer you a unique opportunity to start saving early for their future. But, and this is an important but, the eligibility rules will be tighter than before. So you're going to want to double check that you actually meet the requirements for both the credit and the newborn account. These benefits are generous, but they're not automatic. And unfortunately, if you're a halal investor, they may not appeal to you. And I believe one of the things we had left out here was actually one of the stipulations is that it must be invested into for the Trump accounts, they must be invested into a qualified stock index with fee expense ratios below 0.1%, which unfortunately excludes any of the Islamic funds that we'd be aware of here. So now let's take a look at what this bill is going to mean for retirees and older adults. There's some meaningful updates here that could help reduce taxable income and improve financial flexibility for you during retirement. So if you're 65 or older and your income is below $75,000 for single filers or $150,000 for joint filers, you now qualify for an extra $6,000 deduction. That's on top of the standard deduction. So it's a nice boost, but it does phase out if your income goes above those thresholds. So it's worth checking where you stand. For clients who are just under those thresholds, careful planning could actually help you qualify. Speak with your advisor. Lower taxable income doesn't just mean a smaller tax bill for you. It could also reduce your IRMAA surcharges and the amount of Social Security benefits that are taxed. So this deduction could have a ripple effect across your retirement finances. Very briefly, for those who may not be aware, IRMAA stands for the Income Related Monthly Adjustment Amount. It's a fee that you pay on top of your Medicare Part B and Part D premiums if you make a yearly income above the annual thresholds. So what does this all mean if you're retired? Well, it might be a good time to take another look at your retirement strategy with your advisor. For example, you could think about speeding up some Roth conversions, being more intentional about how you draw from your taxable savings, or even reevaluating the timing of your required minimum distributions. These kinds of moves can really help you keep your taxes lower and steer clear of some of those IRMAA surcharges. And this is really where smart planning starts to pay off. Just a single extra dollar of income can set off a chain reaction across your taxes, healthcare costs, and your retirement income. But here's the tricky part. If your modified adjusted gross income creeps even $1 over the IRMAA threshold, you could actually find yourself paying higher Medicare premiums. And it doesn't stop there. More of your Social Security benefits could also be taxed. And you might also get hit with the net investment income tax, NIIT. In other words, every deduction and smart move that you take advantage of really matters. So from here on out, I'm going to turn it over to Ihab. Inshallah, he's going to walk us through how this tax bill is going to affect estate planning and wealth transfer specifically. So whether you're thinking about legacy, gifting, or minimizing your taxes, there's some important updates that you should know. Ihab, would you like to join us now?
Yes, thanks, Tamim. And yes, there are certainly some big updates that many of our clients will be happy to learn about. One of the biggest changes is the federal estate tax exemption just got a big boost. It's now 15 million per person. That's up from 13.61 million. That's a pretty significant jump. And since it's indexed for inflation, it could keep rising over time. For a lot of families, this means federal estate taxes are less of a concern. This change mainly helps high net worth families because fewer estates will be taxed at the federal level. Still, trust and smart planning remains important, especially if you live in a state with its own estate tax. For example, the state I'm from, Maryland, the exemption is only about 5 million per person, and it's not indexed for inflation. In Illinois, where a lot of our clients are based, it's only 4 million. So estates in states like Maryland and Illinois might owe estate taxes even if it owes no federal tax. So it's key to look both at the federal and state rules when putting your estate plan together, particularly if you own property or have substantial assets in these and other similar states. And even with today's high exemption, estate planning is still important. I like to remind my clients that it's not just about reducing taxes. It's also about making sure your wishes are clear and keeping control over how things are handled and passing over values along with your assets. If your estate is under 15 million, you probably don't need to worry about federal estate tax. But if you're over that amount, or if you own real estate or a business, it's worth looking at strategies like lifetime giving, setting up trust, or making charitable gifts. The exemption is helpful, but it doesn't replace the peace of mind that comes with having a solid plan in place. Speaking of gifts, the annual exclusion has gone up from $19,000 per person in 2025. This means that you can give up to that amount to as many people as you like this year without even touching your lifetime exemption or owing gifting tax. It's a simple tax-free way to transfer wealth to kids, grandkids, or anyone else that you want to support. And with today's higher lifetime exemption levels, this may be a perfect time to take advantage of larger gifting strategies. Locking them now could be smart, especially with future legislation that could lower those limits. Keep in mind, however, that this is not just how much you gift that matters, it's what you gift. Cash, that's simple. But let's say you gift highly appreciated securities, real estate, or other illiquid assets. This can create tax and practical challenges. The recipient takes on your cost basis or your principal and may face significant capital gains when they sell. Sometimes it makes more sense to hold on to those assets until they receive a step up in basis, which is at death. Again, this is why planning with your advisor is critical. And here's a warning. A 15 million exemption is generous, but it's not permanent in political terms. Many clients still need to plan, especially in states with the state or inheritance tax. Also, for Muslim clients, estate planning is more than just about taxes. It's about control and about being able to distribute your wealth according to your wishes. So I urge you not to be complacent. There was so much talk in Congress about tightening the rules around donor advised funds, but those changes didn't make the final bill. That means you can still take advantage of today's favorable deduction rules using a donor advised fund. And don't forget, a charitable remainder trust, or CRT, remains a powerful option too. They can both reduce income and estate taxes while letting you support the causes that matter most to you. In the end, it's about making sure your tax strategy works hand in hand with your legacy goals. Now, starting in 2026, there are a few things to be aware of. First, individuals who itemize can only deduct charitable gifts that exceed 0.5% of their AGI. For example, if someone earns $1 million, the first $5,000 of donations won't be deductible. Also, Beginning in 2026, even higher earners with 37% tax brackets will only receive 35% tax benefit for itemized deductions, which includes charitable gifts. In simple terms, a $1,000 donation would now yield just a $350 deduction. From 2026 onward, those who claim the standard deduction, not the itemized, will get a direct charitable deduction up to $1,000 for singles and $2,000 for married couples. Note, you can apply this to donor-advised funds or private foundations, but it's not indexed for inflation. The bill also keeps the generous rule allowing cash donations to public charities up to 60% of your AGI, which will be tax deductible. Previously, it was only 50%, but now it's permanently at 60%. So what does this all mean? These changes mean donors and advisors need to rethink how, when, and what they give, particularly when the deduction floors and caps kicking in after 2025. It's definitely a shift towards more strategic giving. The next section covers a mix of deductions, some familiar and some brand new. This can make a real difference depending on how you earn and spend. The SALT deductions raised to 40K. One of the most hotly debated parts of the bill is the SALT deduction. If you live in a high tax state like New York, California, Illinois, or Maryland, this is big news. The cap on state and local deductions has jumped from $10,000 to $40,000. That's a huge increase. It applies fully if your income is under $500,000, then it starts to phase out above that. For many families in high tax areas, this could mean some real relief. Now here's a temporary win for workers. Tips and overtime wages are exempt from federal income taxes from 2025 through 2028. Now, this is not a full exemption like Trump promised. These are caps. From 2025 to 2028, you can deduct up to $25,000 of tips and $12,500 of overtime. Anything above that is still taxable. So for example, if you're a restaurant server making $40,000 in wages and $20,000 in tips, they can deduct the full $20,000 in tips since it's under that cap of $25,000, meaning only $40,000 of their income is still taxed federally instead of the full $60,000. Now, this is good news for small business owners. The qualified business income QBI deduction is now permanent. That means if you run a partnership, an S Corp, you can deduct 20% of your business income. This can make a real difference in lowering your taxable income, especially when paired with other smart planning strategies. For self-employment folks and small businesses, this is a major win. Another big win for business owners. It's a great chance to upgrade your equipment or technology and deduct the full cost. 100% bonus depreciation is now back through 2029, which means you can immediately write off qualified equipment purchases instead of spreading the deduction over years. This can be a huge cash flow benefit if you're planning major investments. And yes, this applies to doctors, dentists, and other professionals. So whether it's new medical equipment, dental chairs, or even an updated office tech, you can expense it right away. With all of these changes, it's a good time to talk to your CPA. Should you accelerate equipment purchases before 2029? Are you maximizing QBI benefits? These are the kind of questions that can turn tax law into real savings. Now let's talk about how the bill affects social programs. Now these changes may not grab headlines, but they could have a big impact on families that rely on safety nets like Medicaid, SNAP, and Medicare. And I understand that many of you watching this webinar may not rely on these social programs, but it's still important to be aware of them and how they can impact our less fortunate brothers and sisters. The timeline for Medicaid work requirements has moved up from 2029 to 2026. That's a big shift. Millions of people could lose coverage if they don't meet the new criteria in time. And then with SNAP and Medicare, for example, SNAP, parents are only exempt from work requirements if their child is under 7. And for Medicare, even legal immigrants who paid taxes for decades may lose access. These changes could affect how many families who thought they were secure. These are controversial cuts and disproportionately impact lower income and immigrant households. Now, this slide is really about highlighting how the bill shifts priorities. It's worth having open conversations with family members who may feel the impact. So who's the most affected? Families who depend on income-based programs may face tighter eligibility rules, while estate and business owners are seeing a new relief and planning opportunities. In other words, support tied to income is narrowing, while asset-based strategies are getting a boost. It's a significant change, and the key to understanding how these shifts affect your situation so you can plan ahead with confidence. Now let's take a step back and look at the bigger picture. While the bill offers tax relief and new benefits, it also comes with a significant fiscal cost and some political implications worth watching. According to the projections from the Congressional Budget Office, the bill adds $2.5 trillion in new debt over the next decade. On top of that, the debt ceiling has been raised by $4 trillion. So while many of these changes are popular, they're not free. They'll likely shape future debates about spending, entitlement, reform, and tax policy. I want to make sure our audience understands there are no free lunches. So don't get complacent with higher federal estate tax exemptions or higher standard deductions. Tax and estate planning is crucial to making sure you don't pay more than you absolutely have to over your lifetime. I'll send it back to you, Tamim.
Thank you. Thank you for that, Ihab. That was really insightful, and you're absolutely right. It is so important to remind our audience to stay proactive and do not slip into complacency. So on that note, what can you all do today? First, we highly recommend start by reviewing your tax projection for 2025 and beyond with your CPA and your advisor. See how the new rules are going to potentially impact you. And then second, don't wait until the last minute. Some of these opportunities are only available this year, so it's really important to act before the year end. And then third, remember that tax law will always continue to change, and the best way to stay ahead is by staying informed and planning proactively rather than being reactionary later. And with all these changes coming from the One Big Beautiful Bill Act, this is a really important year to get ahead on tax planning. A lot of the rules around college financing, deductions, and even retirement planning have shifted, and we don't want you to miss opportunities or get caught off guard. So if you are a qualified Azzad Wealth Management client, let's schedule your tax planning meeting soon so we can review your 2025 projections, see how the OBBA is going to affect your situation, and make sure you're taking advantage of what's available now. Inshallah, the sooner that we look at it, the more options that you could potentially have. And that brings us to the end of today's webinar. Ihab and I want to thank everyone who joined us today. We really appreciate you taking the time to be here. If you're looking for more information or you have any questions, please don't hesitate to reach out to us at hello@azzadasset.com. Likewise, you can visit our website and schedule the free personalized discovery call if you're not working with us yet, or if you're already working with us, reach out to your advisor and schedule a tax planning session. And lastly, don't forget to follow us on LinkedIn for more updates, including information on upcoming content and webinars. Thanks again for your time today, and we hope to hear from you soon. Jazakallahu khair. Assalamu alaikum.